Well, hello everybody. This is Ken Winans and Stephanie Larson from Winans Investments. I know many of you already know that, but sometimes you forget what we look like. So anyway, we wish you guys a happy weekend, and I'm sorry that we're so casual today, but we do have casual Fridays in the office. I think it was probably mentioned to you, we are trying to be in the office for at least 4 hours every day, 5 days a week. But again, we're still not staffed here, 40 hours a week like in the old days. We're still trying to honor the.
It's more like 6, but yeah,
Yeah.
we tend to be here. It's more of a 9 to 3 type of thing.
Exactly.
If anyone needs anything, you come in the office. The only requirement with the building is that everyone has to wear a mask to come in the building, and that's to be respectful to Bank of Marin.
Correct. And then Stephanie and I are aware that we're a little closer than 6 feet, but that's okay. We trust each other. So listen, let's talk about, yeah, I know, it's a bad joke. Let's talk about what's going on in the markets right now. So many of you have been asking about how we feel about things. Well, feeling has little to do with it. It's basically how the research points in our direction. So as you know, I follow the market historically based on internal strength. That probably the nice way to look at it are there more buyers than sellers for U.S. stocks? And that is the key point. The answer is yes. And it also is yes for U.S. stocks. It's very clear in my way of thinking that money is still coming to the United States as a safe place to come, that companies here are a better bet. There's better liquidity for our stocks. There's better capabilities for hedging strategies, as you know, that we use, things like that. So as of right now, I'm very comfortable that the internal strength of the market is still pointing in an upward direction. But also with that being said, upward direction does not mean straight up like a fighter plane. It means that there will be zigs and zags, and it could very well be that the rest of the summer could be a bit of, and actually would be very healthy to have a bit of a consolidation before we do another leg up in the fall or going into early next year. So I'm not that concerned that we're not hitting new highs every single day across the board. The other thing to keep in mind is, Stephanie, or do you have anything you want to add to what I just said? Or okay, I'm just sorry. Sometimes I forget to ask questions.
Okay.
Earnings season. So you all need to understand that we are in the middle of earnings season. There will be good, bad, and ugly. There's no doubt about it. The telltale sign was Nike 2 weeks ago. Sales were off 38%, no questions asked. The stock was down 7% that day and really hasn't recovered. So we're going to try to minimize the number of things like that might happen in the portfolio. I think we'll have very few personally. I mean, just based on our historical trend with misses to earnings. But you do need to understand that we are in the middle of that. So if you have cash in your accounts, we're partly keeping it because I want to know who's on target going into the rest of the year. That's very important. Okay, item number 3.
Well, I also talked about that extensively in the quarterly report that will come out today.
Good.
So we also encourage you guys to read that as well. We talked about our strategy moving forward, what we did this last quarter, what we're looking out for. If you've been reading them lately, then you kind of get the gist of what we covered. We actually touched on Nike in that one,
Yeah.
and I think it's a really good read and it's pretty interesting. You'll understand what our thought process is currently and moving forward and what we're looking out for. So I encourage you guys to
Correct.
read it when it comes out.
Absolutely. And please understand a lot, and this is all written in-house. We do not borrow other people's research. That when we talk to you about things, as Harry Truman said, the buck stops with him. Well, the buck stops with us when it comes to our research. So
Yeah, I literally read it.
yeah, Stephanie writes. She's a much better writer than I am. All right, so what I would also say, though, you've often heard me talk about a stock picker's market. And this market is really conducive to our kind of investment strategy, which is buying individual securities. Because I can literally find pockets of strength, i.e. individual companies that have figured out how to deal with this COVID situation. And they're in all industries. I mean, retailers, there's certain retailers that are doing very well. Certain companies in energy that are doing very well. So it depends on who you are and where. So yeah, this is not a strategy to just simply buy the market and hope for the best. So there's definitely pockets of strength, and then that pocket of strength will change over time too. Clearly, a company that ends up getting in trouble, the market's is gonna punish them. I mean, it's just very simple. We're also, the other thing to remember, there's an old adage in our business: don't fight the Fed. And the Federal Reserve is dumping massive amounts of liquidity into this market. You don't want to fight that. Whether it's bonds, the fact they're buying corporate bonds, they've never done that before. The fact they're still honoring the tax-deferred status of preferred stocks. You don't want to try to short into that kind of world. But I do think it's important for you all to understand, and I'll finish on this note, that we will plan on hedging the portfolios if we see deterioration in the market that is severe enough, we will use the same strategies we used before. We will use general hedges against the market. We will trim back on individual securities that are clearly not there. And then, quite frankly, going through this earnings season, any company that really does miss it and has been kind of on our if list, you'll notice that they will be completely removed from your portfolio. So we don't love stocks, they're economic units, and so yeah, if they begin to miss again, we're done with them.
Yeah.
So Stephanie, your turn.
Yeah, that's a good point, and it's actually the reason why we left some cash in the portfolios too, is that we wanted to have that hedgeability. We're still a little, not sure about the market. It's too fast, too far too fast. We're
Sure.
not confident in it. We participated in it, obviously, because you have to go with the way the momentum is going, but we're also a little skeptical about it. We're still watching it really closely. That cash allows us that flexibility, and I'm pretty sure that most of our clients, if not all of them, would be pretty happy with the fact that we're a little conservative in our approach, in the way that we're not just buying in and going fully invested. So we watch it daily. We know everything that's going on, what we're comfortable with, what we're looking out for, and we'll be very active moving forward if we feel we need to be.
Absolutely.
Now, on the bond side, that's a completely different animal. So, you heard me talk several times about how amazing the market was, because all the money went out and the prices dropped extremely low, and then we stepped in and bought all these bonds. Well, unfortunately, when the markets come back up, so have the bond prices. So even though we can still find really good quality bonds, we're not finding them at that extreme deep discount that we were finding in
Stephanie,
April.
real quick, just folks, keep in mind, when we're talking about bond prices, yield is inverse of price. So when bond prices go up, the yield you're going to get as a new buyer of that bond is going to be lower, and same when prices go down.
Yeah.
It doesn't affect you if you already own the bond and you keep the bond, but if you're looking at buying new bonds, remember it's a teeter-totter relationship.
Exactly. And because the rates are historically low right now, it's really put kind of pressure on that market. Any new issuance is going to be at a much lower yield. So we're still looking for existing issuances, still short term. We want the really 2 to 5 year is kind of the wheelhouse. We don't want to be, lending to companies for extremely long term. We've seen a lot of longer issuances actually come out, and we're just not interested. You don't get anything for it. The yield's just not there. Going to the shorter term bonds actually makes a lot of sense. But it's not the whirlwind pricing that we've had. It's just not there anymore, so we're being much more selective in the bonds. If there is even a little bit of a hint of a pullback in the market, actually the bond prices will get a little bit better, and that's when we'd like to step in and buy aggressively. So we're buying what we like, but we're not committing to everything on the bond side. Not like we were in April and May. You should see several new bonds in your portfolio based on cash you had or need. So if you're a 50-50 and you were not at 50% for the bonds, our goal was to get you up fully invested. But if you were already at 50%, then you probably won't see a new bond, if that just makes sense.
I'd add one other part too. So, when we think about bonds, and a lot of our competitors unfortunately don't do a good job of even understanding that there are very strong differences. When you talk about treasuries, munis, and corporate bonds, they're like their cousins. They're very different from the standpoint, they're bonds and they move to interest rates, but the buyers are different, the way they're traded is different. And one of the areas that I personally think is going to come home to roost, I know it's not a popular topic and politicians don't want to talk about it during an election year, but I do think we are going to have municipal bond defaults. Not necessarily bankruptcies of municipalities, but we are going to have defaults, which means that there will be a renegotiation of terms with these various bonds with their owners. I also think that's another reason that you're having people who used to not buy corporates are buying corporate bonds because they are concerned about municipalities. So if you have the Federal Reserve buying corporate bonds and you have muni investors buying corporate bonds, you can see why the prices are as strong as they are.
Yeah.
And I dare say that I doubt we're going to see the bargains that we saw earlier this year with corporate bonds. It doesn't mean that we don't look for them and try to go after them, but we were right when we told you that our focus was on getting the income portfolios built up during the crisis. So I did want to mention to you, you'll notice that behind us is our ego wall with our Morningstar 5-star ranking. We just submitted all of our numbers. I think it's safe to say that we're able to maintain our 5-star ranking on the bulk of our strategies over multiple time frames, and I'm very proud of that. Considering how tough this market has been, we're actually very proud of that. And I just want you to know that, You know, it's probably self-promoting, and PT Barnum would be proud of me doing it, but we are one of the best out there, and I really do believe in that. Let me also bring up, we're also in social media now. I know for many of you, you're probably going, Ken is on Twitter. Yes, I am. Vic Valley will, if you want the addresses and where to go, please contact him and he'll point you in that direction. We have a new website that we're doing. So we really are trying to get the word out. Please feel free to share this with your friends and family members or other folks that are probably looking at ditching one of our our competitors and are looking for somebody new. But anyway, yeah, feel free to please forward it. It's already vetted material and you're fine there. And I would just like to just say that, look, we know this has been a very tough time. We're not done with this yet, okay? I know that we're seeing a second wave of restaurant closures out where we are. We just want you all to know that, too, that we're being careful ourselves personally. This staff takes this very serious, and that we have a contingency plan in place in case any one of us happens to come down with this illness. So you should not see any disruption at all. But with that being said, we need to talk to you briefly about back office situations.
Yeah.
Stephanie, why don't you jump in on it?
Yeah, well, several things actually. We mentioned before how the back offices at the custodians are still really bad. They're still really bad. We're particularly having a really hard time with Schwab. They are essentially all working from home, and it's taking a really long time to have things go through. And also part of the problem is that, you know, normally when you're in the office and you sit like this and you have two people in the back office that can do the same thing, they can just say, hey, Ken, do that, and they'll go, okay. That's not happening now. So we literally had a problem this week where we had a wire that needed to go through. The request went in, email was confirmed, on the phone, confirmed it again, and they literally just didn't push the button. And there's nothing we can do about that. It's insane. So if you need anything, please let us know. We will follow up with them. We will work. We have an actual service team that is assigned to us within Schwab and TD that we can go to directly. So if you need anything, just let us know. We will take care of it. But understand it's taking still a really long time, and there's a lot of mistakes that are being made in the back office. Also, we've had a lot of requests lately for cash, whether it's for tax season or whatever that's going on. We're happy to process them. You know, if you need something for tax season, the absolute last day that you have to let us know is Sunday. Email us, call us, whatever it is that you need to do, because that means Monday morning I need to go in and trade for you to get that cash available for you to do your taxes. So just let us know about that. We're working it the best that we can, but it's still really challenging right now. And then lastly, I want to say also, we've noticed that with our clients, you know that we watch our accounts every single day for any alerts or discrepancies or issues or things that are going on. We've noticed about a dozen of our accounts actually went into negative cash, and the reason they went into negative cash was because the client overspent on it, overspent on checks or whatever was happening, and the cash literally wasn't there. We have all of our accounts set up on margin for that in case that happens, so that, you know, we don't get into an issue with the custodians.
And you don't bounce checks.
And you don't bounce checks. However, we still need to bring you back into essentially a non-margin situation. And so we only catch that after the fact and when we do our reviews of all of our accounts. But if you need something and you're not sure how much money you have in that account, please just let us know and we'll help you out. We'll raise the money for you, we'll raise the cash for you. Mm-hmm. Don't just write, you know, blank checks and assume that everything's going to be okay, because at some point you might actually just not have the money there. So please just let us know. Like I said, it's been about a dozen that we've seen in just the last 2 weeks.
It's a pattern. It's
Yeah.
a pattern of things. And also, many of you probably know this. You probably haven't looked at them in a long time, but you do have convenience checks on your brokerage accounts. Folks, I'd much rather you use those checks than try to get us to do a small wire here or there. Please use those checks. They will clear. I actually use them myself. They're fine, but it's much better than having us try to do a wire for a very small amount of money. But those checks will be honored by the IRS if you want to write that. I would also bring this up. Look, just like we are, I'm sure a lot of the accounting firms are also in a scramble mode right now. As you all know, tax deadlines have been extended, moved, and all kinds of stuff. Personally, if you are still in scramble mode, I would highly recommend, although I am not an accountant, but I would highly recommend you talk to your accountant and seriously consider moving your extension to the October 15th deadline, which is still in place. Mm-hmm. There's no reason to go into a stress out mode, even if you end up owing a little bit of money, I mean, I know for a fact that the interest rates and penalties on those kind of things are really not that large. So I would just encourage you to be aware that this is not the only extended deadline. You do have until October to deal with 2019 taxes. And I've been doing it for years myself personally. There's no problem with it. You're not on some red list with the IRS for doing it. There's nothing like that. But I just don't see the sense of beating yourself up and scrambling if you're just not ready to go. Last couple of points I would like to bring up on good news with the company. We are still moving ahead with expanding our Las Vegas operations. Obviously, traveling right now is problematic, but I met with Vic Valley, who is our VP of Marketing and Business Development last night, and we are prepared to move ahead. We are still looking for opportunities to expand in a way that does not harm the service to you. You're our priority, the existing clients that we have, but our firm is doing very well right now relative to what's going on in our industry, and we'll certainly keep you posted on that. There is also a possibility that we might have a presence in Arizona. So I will keep, many of you are moving out of California. I'm just telling you that there's a chance we're going to have multiple offices in multiple states going into 2021. So just be aware for that. And then I just want to thank you again for being a client. We appreciate your patience, and I know that you're very loyal to us, and we're very loyal to you. And Stephanie, anything you want to add?
No, we just want to say thank you. We know that it's been a very interesting 2020, to say the least. There's been a lot of ups and downs, but I think we've done extremely well, and we're extremely grateful for you to be our clients, and we hope that you guys are happy with us as well. And then we'll see what happens with the rest of the year. It should be interesting. Right. We'll just see. We'll keep how many times we can say the word interesting.
Yeah, well, it's going to be, remember, we got an election year coming up. One thing I've had to tell several clients, look, during election years, economic news can be tainted and twisted to serve a political situation. I would just caution, I would really watch the markets. The markets will tell you what's really going on. And I listened to statements from the Federal Reserve. They are supposed to be a non-political, nonpartisan group. But I would just caution you, this is not the time to be making radical asset allocation decisions based on some news story you heard. Let us do that job. If there's a logical reason to change the strategy, then by all means we need to do that. I want to bring up one last thing. Restrictions placed by clients.
Yes.
We have a tendency where client restrictions, people seem to forget that they tied us up on something. Please keep this in mind. In the last round of contracts that you signed or gave us, we are looking at restrictions expire at the end of every year. Well, I just discovered the other day that there was a client who restricted money 3 or 4 years ago on a home purchase that was never lifted. And it's too bad because the client never told us that they bought the house or didn't buy the house. And I noticed in the address they had moved. Folks, it's hard for us to manage money as it is, but if you're going to place restrictions on us, you really have to take the responsibility to let us know. We can't read minds. Please let us know if the restrictions have been lifted. But I'm gonna tell you right now that on people who that have not made it categorically clear to us on a certain restriction, I'm lifting them at the end of December. I just want you to understand that right now. We're growing very fast. We just don't have time to try to second guess what's going on here. So you just need to know as we go into the fourth quarter, if you told us something this year and you haven't reiterated it to us in writing, it's off. It's back to normal going into January.
Well,
so
it's honestly for your benefit. If you have $300,000 that's restricted because you think you might buy a house and then you don't, well, that $300,000 is not being invested, and you've missed out on actually a really good rally, for example. So if you need it, absolutely, please restrict it so that we're well aware, and we'll make sure that we don't overbuy for your portfolio. But if you don't need it anymore, then we ask that you please just let us know.
Yeah, that's one of our new clients. That's one of our new clients behind us. We're working on the younger generation, getting them invested.
That's what happens when you don't have summer camps or school or daycare.
Yeah, exactly.
I have to drag them into the office every once in a while.
Well, it helps it when you've had a museum, you know how to deal with kids. So, folks, listen, have a wonderful weekend, and we'll plan. Oh, and video-wise, we forgot to bring this up.
Yeah.
Go ahead.
We're thinking at least bi-monthly. If the market volatility picks up, then we'll obviously do a lot more frequent.
Special reports and stuff.
Exactly, things like that. But we'll probably move to 1 or 2 a month from now on. Mm-hmm. You also get the monthly letters from us and everything else. So I think we're pretty good with getting all of our information and communication out there. Obviously, if you ever need anything, you can come to us directly. It's not a problem.
I'm overdue for a Forbes article, which you'll all get out pretty soon. I'm going to probably do one on pandemics and investing. There's some other things that a lot of people in the media have just not covered,
Yep.
but we'll cover that as well. So anyway,
And Ken and I have also been talking about a book.
we have.
Maybe,
That's right.
maybe not. We'll
That's
see.
right. Don't worry, you won't be mentioned in it. We won't bring up any client names.
Yeah.
Just kidding, of
No.
course. No, we're talking about a lot of different things.
Yeah.
So remember, we're always doing research here, folks. We're always thinking. I will tell you, Stephanie and I, and certainly Vic and I, we have texts going back and forth very, very early in the morning.
5 a.m.
Yeah, and I mean, the sun's not even up yet, and we're already texting each other. So just so you know, we are working all the time, even though you might be able to get a hold of us, we're around. So folks, take care of yourself, have a great weekend, and we hope that at some point in time, maybe going into early next year, we'll be able to see each other again face to face. So take care of yourselves.
Thanks, guys.
Bye-bye.